I want to start with a number that genuinely made me stop and stare at my screen when I first came across it. The average age of a first-time home buyer in America right now is 40 years old. 40, let that land for a second. In the early 1990s, that number was 28. So in roughly 3 decades, the average person buying their first home got 12 years older. 12 years of extra waiting, 12 years of extra renting, 12 years of watching home prices climb while the dream of ownership kept getting pushed just a little further down the road. And if you are somewhere in your late 20s or 30s right now, staring at this market and feeling like something is fundamentally broken, I want to be the first person to tell you directly, you are not wrong, you are not bad with money. You are not failing at adulting. You are navigating a housing market that is structurally broken in ways that have nothing to do with your personal financial discipline and everything to do with decisions made by builders, banks, and policymakers over the last 20 years. Today, I am not going to sit here and tell you to cut out your morning coffee or pick up a second job. I am going to walk you through exactly what is actually happening in this market, why the strategy most people are waiting on is probably going to backfire on them, and what I think the 2 most practical paths forward actually look like in 2026. Real strategies, real numbers, no fluff. If you are new to this channel, subscribe right now. Every week I sit down with you and work through exactly this kind of thing. Money, markets, real decisions for real people. Let's get into it. First, I want to make sure we are both looking at the same set of numbers, because I think a lot of the frustration people feel about housing comes from a vague sense that things are expensive without understanding just how structurally out of reach things have become. To buy a median-priced home in America right now at a 6.5% mortgage rate, you need a household income of somewhere between $106,000 and $110,000 to keep your housing costs within the traditionally recommended range. The median household income in America is $83,700. I want you to feel what that gap actually means. The median family in America earns about $83,700 a year. The median home requires $106,000 to $110,000 to be remotely affordable. That is not a small gap. That is not a gap you close by being more disciplined or working a little harder. That is a structural gap, a policy gap, a decades-in-the-making gap. And I think it is important that you and I name it correctly before we talk about what to do about it, because if you misdiagnose the problem as a personal failure, you will spend your energy trying to fix the wrong thing. So why is the market frozen the way it is right now? Let me walk you through the 2 forces that combine to create this situation, because understanding them is going to be critical when I explain why the strategy most people are counting on is not going to work. The first force is something I call the mortgage trap, and it is unlike anything this housing market has ever experienced before. Right now, 51% of all existing mortgages in America have an interest rate below 4%, and approximately 20% of mortgages, 1 in 5, have a rate below 3%. I personally know people sitting in homes at 2.75% who bought during the pandemic era and they are not moving. I would not move either, because here is what moving would cost them. If you leave a 2.75% mortgage on a $350,000 loan and take out a new mortgage at 6.5% for the same amount, your monthly payment increases by roughly $730 per month, every single month for the exact same loan amount. That is $8,760 per year. That is $87,600 over 10 years just in additional interest costs. So millions of homeowners are sitting in their houses, not because they do not want to move, but because moving is genuinely financially irrational for them right now. They are locked in. And that lock-in effect has strangled the supply of existing homes on the market because the people who would normally be selling are not selling. The second force is the housing shortage that built up over 15 years of underbuilding. After the 2008 crash, homebuilders pulled back dramatically. For a decade and a half, America was not building enough homes to keep up with population growth. The estimates I have seen put the current shortage at somewhere between 3.5 and 4.5 million homes. Not units, homes. Millions of homes that simply do not exist and that are not going to appear overnight. So what you have is a market where supply has collapsed because existing homeowners will not sell, demand remains strong because people still need places to live, and the underlying shortage means there is no structural floor that is going to push prices dramatically lower anytime soon. Supply and demand have both frozen at the same time. That is the freeze. And now let me address the thing I hear constantly when I talk to people about this. Everyone is waiting for 2008 to happen again. I hear this all the time. I see it in comments. I see it in conversations. I'm just going to wait for the crash and buy at the bottom. And I understand why people think this. The 2008 crash is the last time homes were genuinely affordable for a wide range of buyers. So the brain naturally reaches for that as the template. But here is why I think this particular waiting strategy is dangerous, and why the conditions that caused 2008 simply do not exist right now. In 2008, the crash happened because of catastrophically bad lending. Banks were handing mortgages to people who had no realistic ability to repay them. No income verification, no meaningful down payments. Adjustable rate mortgages that reset to payments borrowers could not afford. By 2009, 26% of all mortgaged properties in America were underwater, meaning people owed more than their homes were worth. That triggered a wave of foreclosures that flooded the market with distressed inventory and caused prices to collapse. Now look at where we are in 2026. The median credit score for a new mortgage is 758. In 2006, at the peak of the bubble, the median was around 700. Lending standards today are dramatically tighter than they were in the lead-up to 2008, and today only 2.2% of mortgaged properties are underwater. Compare that to 26% in 2009. American homeowners are currently sitting on nearly $36 trillion in collective home equity. These are not people who are going to be forced to sell at fire sale prices. They do not need to sell. They are sitting on enormous equity cushions. There is no foreclosure wave coming that is going to reset prices to 2012 levels. The structural conditions for a 2008-style crash do not exist right now, and I think people who are waiting for that specific outcome are going to be waiting for a very long time. But here is the twist, and this is the part I really want you to pay attention to because I think it is the most counterintuitive and most important point in this entire video. Waiting for rates to drop dramatically might actually make your situation worse, not better. Let me explain exactly why I believe this. Right now, the market is frozen partly because rates are high. Buyers are sidelined, sellers are locked in, activity is suppressed. It is uncomfortable, but it is also relatively stable in terms of prices. Now imagine rates drop quickly to 5%. What happens? Every single buyer who has been sitting on the sidelines for the last 2 or 3 years floods back into the market simultaneously. Millions of people who gave up or paused suddenly feel like now is the moment. Demand spikes dramatically almost overnight. But remember the underlying shortage. We are still 3.5 to 4.5 million homes short. The supply does not magically appear because rates went down. So what you get is a massive surge in demand crashing into a supply that is still severely constrained. And when demand spikes and supply does not, what happens to prices? They go up potentially sharply and quickly. So the scenario where rates drop and you finally feel ready to buy might be the exact scenario where the prices jump out of reach again before you can act. I have been thinking about this dynamic a lot, and I genuinely believe it is the biggest underappreciated risk for people who are currently in wait-and-see mode. So if waiting for a crash is not the answer, and waiting for rates to drop might backfire, what is the answer? I want to give you 2 concrete strategies that I think actually make sense in this environment, not theoretical strategies. Strategies with real numbers behind them that you and I can actually act on. Strategy 1, rent intentionally and invest the difference. I want to spend a real moment on this one because the renting is throwing money away narrative is one of the most financially damaging pieces of conventional wisdom that I keep encountering. It gets repeated constantly, and it is just not true in all situations. It is especially not true in an overpriced market, and I want to explain exactly why with numbers. Buying a home only makes strong financial sense when your total housing costs, mortgage, property taxes, insurance, and maintenance stay below 28 to 30% of your gross income and when you plan to stay in that home for at least 7 years. That 7-year threshold matters because of transaction costs. Buying and selling a home costs roughly 8 to 10% of the home's value when you add up agent commissions, closing costs, and moving expenses. You need several years of appreciation just to break even on those transaction costs alone. Now, if buying that median-priced home is going to stretch your housing costs to 40 or 45% of your gross income, which is exactly what the current numbers suggest for the median American household, then buying is not a wealth-building decision. It is a wealth-constraining decision. You are tying up your cash flow, your flexibility, and your investment capacity in an asset that may not appreciate fast enough to justify the cost. Here is what I think is the smarter play for a lot of people right now. Rent a place that keeps your housing costs genuinely comfortable, somewhere in that 28 to 30% range or ideally lower. Then take the difference between what renting costs you and what owning that same home would cost you, and invest it every single month into a low-cost S&P 500 index fund. I have run these numbers personally and I find them genuinely compelling. If buying a home would cost you $2,800 a month and renting a comparable place costs you $2,000 a month, that $800 difference invested consistently every month at a historical average market return builds serious wealth over a 7 to 10-year horizon. Real, liquid, accessible wealth that you can deploy however you choose, including toward a home purchase when the market makes more sense. The real estate industry is not going to tell you this, and I say that without judgment because it is simply true. Nobody earns a commission when you put money into an index fund. The entire incentive structure of the real estate transaction is built around encouraging you to buy. Understanding that incentive structure does not mean you should never buy. It means you should make the decision based on your own numbers rather than on cultural pressure or someone else's commission. Renting intentionally while investing the difference is not giving up on homeownership. It is choosing wealth-building strategy over cultural narrative. And in this specific market in 2026 with these specific numbers, I genuinely believe it is the right call for a large portion of the people who feel pressured to buy right now. Strategy 2. If you are going to buy, go after new construction and know exactly what you are looking for. Here is something interesting that is happening in the new home market right now that I do not think gets nearly enough attention. Homebuilders are in a very different position than existing homeowners. They cannot afford to wait out the market the way an individual homeowner can. They have land costs, construction financing, and business operations that require them to keep selling homes. So unlike existing homeowners who are locked in at 3% and refusing to sell, builders are actively competing for buyers, and they have a tool that individual sellers simply cannot offer. Rate buydowns. Many builders right now are offering to buy down your mortgage rate to somewhere between 4.5 and 5% using money that would otherwise go toward their own profit margin. That is a meaningful difference in monthly payment. On a $400,000 mortgage, the difference between 6.5% and 5% is roughly $380 per month. That is real money every single month that stays in your pocket. And here is the part that I find genuinely surprising when I look at the current data. Right now, the median price of a new construction home and the median price of an existing home are at near parity. Historically, new homes have commanded a premium over existing homes, which makes sense because everything is new and under warranty. That premium has compressed dramatically as builders have worked to move inventory. This means you can potentially get a brand new home at a similar price to a comparable older home, while also getting a better interest rate through the builder's buydown program. That combination is genuinely unusual, and it is worth paying serious attention to right now. But I want to give you one important warning on this strategy, because missing it could cost you real money. Some builders inflate the base price of the home specifically to cover the cost of the rate buydown they are offering. So the house that is listed at $420,000 with a 5% rate buydown might actually only be worth $390,000 in the current market, with the extra $30,000 baked into the price to fund the buydown offer. You end up with a lower rate, but you overpaid for the home itself, which means your equity position is weaker from day one and your appreciation upside is reduced. The way I would approach this is to get an independent appraisal, or at minimum do serious comparable sales research before committing to a new construction purchase. Understand what similar homes in that area are selling for without builder incentives. Then calculate whether the effective cost of the buydown deal makes sense when you account for the actual market value of the home. Do that math yourself. Do not rely on the builder's sales team to do it for you because their incentive and your incentive are not the same. Let me bring this all together before I let you go because I think the emotional weight of this topic is real, and I want to acknowledge that directly. If you are in your late 20s or 30s right now, watching your parents' generation talk about the house they bought for $180,000 that is now worth $650,000, feeling like you are playing a rigged version of a game that worked fine for everyone before you, I hear that frustration. I feel versions of it myself. The housing market in 2026 is genuinely harder to navigate than it was for previous generations, and that is not a personal failing. It is a structural reality. But here is what I keep coming back to. The worst financial decisions I see people make in this environment are driven by emotional pressure rather than actual numbers. Buying a home that stretches them to 45% of their income because they feel like they are falling behind. Waiting for a crash that the current data suggests is not coming. Sitting paralyzed doing nothing because every option feels imperfect. The options are imperfect. This market is imperfect, but you can still make smart decisions inside an imperfect market if you are working from real numbers rather than cultural narratives. Know your actual housing cost ratio before you commit to anything. Understand that renting and investing is a genuine and legitimate wealth-building path. If you are going to buy, understand the new construction opportunity and protect yourself from the pricing trap. And stop waiting for 2008 because 2008 is not coming back. That is the escape plan. Not a perfect plan, but a real one. Hit subscribe if you want to keep having these kinds of honest conversations with me every week, and share this with someone in your life who is stuck on the sidelines of this housing market feeling like they are out of options. They are not out of options. They just need the right map. This is Dave. I will see you in the next one.